how do you write off an accounts receivable that has gone bad? You sold on account, knowing very well that probably some of those sales wouldn't be collected, and sure enough it's come to pass that someone hasn't paid you. So how then do you write off an accounts receivable? There are two methods that are used in industry. One method is called the direct write-off method, and the other method is called the allowance method. And these are the two methods you can use to actually write off an accounts receivable. The entry under the direct write-off method, and it goes bad debt expense for the amount that you're writing off, and directly into the accounts receivable, and directly writes that amount off. It gets its name, the direct write-off method, because the credit goes directly to the accounts receivable and the account is written off. The pros of the direct write-off method are, yahoo, it is easy. The cons of the direct write-off method are pretty significant. First of all, it's bad matching. As a general rule, you'll work hard to collect an accounts receivable. As it gets older, you'll turn up your collection efforts. It's likely to be written off in a period other than the period the sale was recorded. So it has bad matching of expenses with revenue. But perhaps the worst con is if your bad debt expense are of any significance at all, this method is not in accordance with generally accepted accounting principles. We do show it to you, however, because it is used in income tax preparation, and small businesses that have insignificant amounts of write-offs may very well use this method. And so, here's your entry. Bad debt expense and a direct hit to the accounts receivable. Let's now move on to the allowance method. When you write off an account under the allowance method, you debit the allowance for doubtful accounts we talked about in our earlier pincast. I'm going to use some shortcuts to write this. Allowance for doubtful accounts. And you credit accounts receivable. So you do not directly hit bad debt expense. Rather, you go directly into the allowance account. It still writes off the accounts receivable, but it doesn't do it directly into bad debt expense as the direct method did. It takes it to an allowance account. The allowance account was set up at the end of the accounting period with an adjusting entry. So the write-off under the allowance method is to the allowance method. The pro of this is it has really good matching. You match the expense and set up the allowance in the period of the sale. It also shows the accounts receivable at net realizable value on the balance sheet date because you have set up an allowance that reduces it to the amount you actually expect to collect. If there are any cons, it's that it's maybe a little more difficult to do the accounting, but not much, as you'll see in upcoming pincasts. So, in summary, The direct write-off method of writing off an accounts receivable goes directly to the bad debt expense account and accounts receivable. The allowance method of writing off an accounts receivable goes to the allowance account. So the very names tell you what account you're going to debit. And remember the terminology. This is how you write off an accounts receivable. You've given up collections on it and you're writing it off.